Six well-known retailers released quarterly earnings this week. Kohl's, Macy's, Best Buy, Dick's, and Burlington are going to be reporting before the open tomorrow, and Nordstrom will be reporting afterwards. Their results may provide some insights into the state of the U.S. consumer going into the holiday shopping season, and we're going to talk about two of them today on Open Interest. Hello, everybody, and welcome. I'm Mike Koh. Welcome to Open Mic. For those of you who tune into this regularly, I'm sorry I couldn't do our regularly scheduled live stream last Wednesday. As you will know, if you were following us on Monday and Tuesday, I traveled down to Miami to participate in the Crossroads Summit, which was being sponsored by TradeStation. That was their inaugural event. And I might actually highlight a couple things that came up at that conference, which I thought were rather interesting, before moving on to the retail names that I was just talking about. So they had a number of very interesting speakers there, including the author of The Fourth Turning. Jamie Metzl was also speaking at this. We had some folks from the quantum computing space who were speaking. Peter Zahan. Peter was actually the one that opened up the conference. I don't know if any of you happen to follow him. But one of the points that he was making, which I think is just interesting to touch on, and I thought I would share it now because it's not the kind of data that we typically look at. So I'm just going to, I have a couple slides here. I'm just going to pull it up on another screen. I'm not going to do a full presentation on it. But I just wanted to, to highlight a couple slides, just things to think about. That Peter had brought up that I thought were interesting, and because I'm going to be talking about some alternative data, I thought this might be rather interesting. So if we're able to pull up the screen share. This is going to be a little bit difficult if you haven't seen one of these slides before. What you're looking at here is a chart of demographics by age cohort. And the one that I think is kind of interesting, so this one here is China. One of the things you're going to notice with China is that they have right here, they have fewer young people than they have older people. So you can see that the cohort that is between, say, 50 and 60 years old is larger than any similar group below the age of 30. And this is one of the reasons why too much echo I'm seeing is coming through. And I unfortunately can't hear what you're hearing, so I don't know where that echo is coming from. Let's see what's going on there. Okay, so testing 1, 2, 3. Hopefully you don't have too much echo coming through. So if that resolved, please drop it into the chat because I can't hear what you're hearing. I think the production side probably can. Not sure what was going on there. Okay, good. All right, so if that was a little bit too echoey, let me just recap here. This is a population chart for China based on age cohort, oldest age group at the top. Of course, that's eventually going to come to nothing as there aren't too many 200-year-old people out there. But one of the things that you may have seen was that within the last year or two, the average age in China actually exceeded that in the United States. And I think this is interesting because obviously we have a lot of sort of global geopolitical, global macro events going on. But this is important when it comes to having a sustainable economy. China has a lot of problems. They have borrowed a lot of money to overbuild real estate. There's a lot of different statistics on that, which you're able to look up. But I don't think that the Evergrande thing has completely resolved that. So that's the first point I would make. And when we think about places to invest, and I'm bringing this up because I had, I've constantly sort of toyed with this idea: have Chinese stocks gotten cheap enough? FXI, KWeb, as far as the ETFs are concerned, BABA, Baidu, Pinduoduo, names like this, are they getting cheap enough? Now, of course, some of those businesses operate outside of China, but I was reminded last week that the amount of leverage in their system is incredible and excessive. The collateral that backs it is questionable. And the demographics that would support those assets in the long term doesn't exist. So the one-child policy did have the impact of reducing childbirths. Also, because there was some self-selection, you can see here on the left-hand side in dark blue, that represents effectively the male surplus, so the extent to which the male population exceeds that of the female population as a function of sort of that selection process. So that is a problem for China. I just thought I would throw that out there because I think it's something to think about. And this is Europe. So, and we can sort of see how this evolved. We can see that they have a similar demographic problem. That is that they also have fewer young people. And as a population ages, the younger population are the ones that are paying into the system. The older population is one that's taking out of it. Younger population typically spends more than the older population will. So this can also help speak to why Europe is, from an economic perspective, moribund effectively compared to the United States. This, I don't know how this is going to show up on your screens, but this will actually show the evolution. You can see things like the impact of the population that went to war, which obviously got decimated, and of course the wartime, but sort of how we got to where we are. So you can sort of see the population growing. Looked a little bit like a pyramid at the beginning, which is kind of how you want it to look. And then you can see sort of a hollowing out of those younger generations. Now, if you compare and contrast that then to the United States. Now, in the United States, we also have, it's not a pyramid necessarily, but our demographic picture is notably better than it is in China, than it is in Europe. And I don't have it because we don't need to go through each and every one of these. But you're going to see this in a lot of places. If you look at South Korea, for example, very similar pattern. This is essentially the population in the United States. And you can sort of see that it maintained that sort of growth that you would expect of a growing population. Hopefully the younger populations, the younger portions of the population are equal to or greater than the older population, because if you get into a situation where it's really inverted, as it is on this one, for example, that becomes a little bit more unsustainable. So I just wanted to point that out because to the extent that people often will say, oh, the grass is always greener, I thought that served as an interesting reminder that that's not necessarily true. If we think that China is going to eat our lunch in every possible aspect, that's not necessarily the case. Certainly Europe has some demographic problems relative to the United States. And there's a couple other things that I think are, and I've mentioned this before, I was on CNBC earlier. So Scott Bessent is Trump's nominee for Secretary of the Treasury. He has this 3-3-3 plan that he's talked about. So what he wants to have is at least 3% economic growth. He wants to get the deficit down to something like 3% of GDP. And he wants to increase U.S. energy production by 3 million barrels per day. Increasing energy production obviously can do a lot in terms of, because energy is an important constituent or component of inflation, one can see why you might want to do that. I would just offer the following, which I think is worth mentioning. U.S. oil and gas production has never been higher than it is right now. We're the largest oil and gas producer in the world by a good margin now, over second place Saudi Arabia. We're, to keep it in round numbers, we're probably producing something like 22 million barrels a day equivalent of oil and gas in the United States. And that meets or exceeds actually our domestic demand. So for the first time in a long time, one could say we're essentially energy independent. And that might be one of the reasons why things like West Texas Intermediate aren't doing very well. So I think there was a perception by some, and there was some justification for this, that the Biden administration, for example, wasn't particularly friendly to oil and gas, that they were trying to restrict some oil and gas project, whether it was midstream stuff like the Keystone Pipeline, whether it's E&P things like drilling in the ANWR in Alaska. It's hard for me to imagine what it is that the Trump administration can do at this point to stimulate more production than what we already have, because, of course, the biggest driver for investment in the space is going to be high oil prices. So when oil prices are high, that encourages development and investment in the space. And when it isn't as high, then it isn't going to be quite so strong. You should think about the integrated oil companies as a basket of their reserves. So, if you a simple way to think about it is that if a company has 100 million barrels of reserves, and you sort of discount that based on the price of crude, we'll call it 60 to keep the math easy, then that's $6 billion, right? So whether or not the industry is encouraged to try to increase development is going to depend heavily on where oil prices are now and what they think they will be in the future. That said, they could do some things like open up some areas. They can speed the permitting process. They could encourage, some of the midstream projects like pipelines and things like that. They could, do things to try to help get LNG terminals online. That's assuming that there's an interest in doing some exports. One other quick point I would make, which is that you can generate or you can produce all of the energy that you consume, but it may not be in the form that you want it. So you can imagine that if you refine a barrel of crude oil, for example, that about half of that's going to turn into gasoline and maybe a quarter of it turns into diesel as part of the refining process when you crack the hydrocarbons. And maybe our demand for diesel and jet isn't so great that it would consume all of what we create. And maybe our demand for something like gasoline is higher. So, that is going to create some transoceanic trade in the products to essentially, see to it that you have, basically the supply of goods going to the places where it's most needed. For example, in France, for a time, more than 50% of the cars on the streets in France were diesel. So their relative diesel demand compared to gasoline was higher. That was, of course, due to government subsidies and things like that. Okay, so with that very lengthy segue that I just took, let's get back onto retail. And I wanted to talk a little bit about Kohl's Corporation, which is down precipitously this year, and Burlington, which is up quite a lot. So I'll quickly pull these up. Kohl's stores, so we can take a look and just compare the performance of these two. And what I wanted to talk about a little bit, so here's Burlington. Burlington was up well over 40% year to date. Look, it's up another 5.5. This is when I was looking at it yesterday. It's up another $5.50 today. Street is pretty overwhelmingly bullish on this one. So thing is trading about 36, I think, or it was trading around 36 times earnings when I was looking at it. Let's see where it is right now. Yeah, with today's pop, it's up even higher, 39.7 or thereabouts. So a pretty good turn for a retailer. I think that's also true for Dick's, by the way. And part of that is because we've been getting this very nice year-on-year EPS growth. So they've been growing the top line 11, 12%, and we've been seeing EPS growth in the neighborhood of 40 to 50%. Full year expectations, so their fiscal year ends at the end of January, is going to be about 31%. So that PEG ratio, which we were talking about last week, a little over 1. So not terrible, but you need to have sustainable growth to justify trading, if we're just, again, I like to use round numbers, is trading close to 40 times earnings. Compare and contrast that with Kohl Stores. This is the performance of Kohl Stores year to date. Up a little bit today, actually up a lot. But this one was down 40% year to date, give or take, when I was looking at this yesterday. Why is this? Okay, so number one, Street hates it. 3 buys, 8 holds, 6 sells. So that was definitely a part of the problem. The other part of the problem was that, top line has been pretty miserable. So as we were seeing 11 to 12% growth at Burlington Stores, this one has actually been declining. 2023 year on year, 6.9% year on year declines, 3.4, 3.6. And as you know, generally, I like to see companies' top lines growing at least the pace of GDP growth. If we figure that's 3.5, 4%, this is underperforming that by close to 7. Unsurprisingly, then, it is now trading at quite a cheap multiple. Now, yes, about 7 times, 7.2 times. So what occurred to me, and this is not some data that I think I've shared that much in the past, but the things that I'm showing on the screen right now, this goes back for years, right? So this shouldn't be a big surprise to anybody. Why has, if we've been seeing these top line declines over the course of the last couple of years, why has the stock been so weak just over the last several months? And why has Kohl Stores, which it's not like the fundamental performance is new news, why has that one been doing so relatively well in recent history, since all of the information that I was just showing you is in the public domain, and it's been in the public domain since they last reported? So what is it that people are looking at with respect to these two companies that has created this huge outperformance? And I think over the last 30 days, the outperformance was something like 35%. And the answer to that is alternative data. So you may or may not be aware that there are other sources of data other than company financials that people look at. So let's just talk a little bit about what could potentially be driving these things. Burlington has a slightly more affluent demographic. We talked about that in the context of Dollar General and Dollar Tree and some other companies. We actually mentioned this also when I was talking about BJ's Wholesale last week before they reported earnings relative to Costco. Costco skews a little bit more affluent than BJ's. BJ's more of a grocer, accepts manufacturers' coupons, things like that. Obviously, those results turned out pretty well. And, we're going to be looking at these companies sort of in a similar context. But this is the kind of data, if you can see on my screen right now, that you might not look at that often. And alternative data is effectively, this is data that you're not looking at the fundamentals. So alternative data refers to non-traditional data sets that are used by financial analysts and investors. Their hope is to get unique insights into market trends, consumer behavior, and company performance. And this is, unlike conventional data, which would include things like earnings reports, balance sheets, economic indicators, you might consider sell-side research and stuff like that. Alternative data is often gathered from sources that are not related to the company themselves. And in some cases, this alternative data can give you information that is more up-to-date than those conventional sources. It can be real-time or near real-time information. This could include things like transaction data from the credit card companies or debit card companies, foot traffic data, which alternative data companies can compile from everything from mobile phones. So in this case, you can see over here in the upper right-hand corner, maybe you can, where it says Placer AI. I don't know if you can make that out there, but they track foot traffic, and they have some 25 million mobile devices that they can track. About half of the, it's about half and half. I think a little bit more iOS devices than Android, but that gives you some sense. Visa sells data. Now, of course, not all of the information is being sold. It's not like if you're using your Visa card that your name and home address and telephone number and exact purchases are being relayed in this way. But a lot of information is. And what ends up happening is you can then take a look over the last 7 days, if you can see this, 28 days, 91 days, at the observed sales. You can take a look at customer traffic, right? See, we can compare this to other stores. So right now we're looking at Burlington, and what we can see is that in terms of foot traffic and in terms of observed sales, in terms of transactions, in terms of the amount of sales on a per customer basis, the number of transactions per customer, we can actually see things that you're not going to be able to get from the company straight away. Day and contrast this table, which has a decent amount of green in it here. The average transaction value, we can see 28-day and 91-day was actually slightly lower, but the 7-day is slightly higher. Compare and contrast that now with Kohl's stores. And it's going to look very different. All red, as you can see here, pretty much. This one slightly better, there slightly better. But in general, what we're seeing is that the observed sales are lower sequentially. The observed transactions are lower. So I think that actually accounts for a lot of the price action, right? So people are seeing this kind of thing in real time. They can respond to it in real time. This is consistent with the trends that the company's own reported data had been providing over the course of the last couple of years in both cases. And so, unsurprisingly, the stock performance is following suit. So as we think about how to trade this, obviously we're going to get some new information when these guys report tomorrow in both cases. And I'm sure management's going to provide some insights. But I actually suspect that at least some of the news is being baked in. We can kind of, we can weave a narrative that basically tells the story. Kohl's top line had been declining, and it wasn't a great story. Actually, they were holding their EPS in pretty well, all things considered. So the top line was going down, but EPS had basically flatlined. But the stock, obviously in Kohl's case, has performed very poorly going into the print today, notwithstanding. And Burlington Store performed very well. And I suspect that a good portion of that is related to this data. So other things that they can do, for example, satellites have been tasked to look at parking lots. I can remember actually seeing some of the shots from outside of Sears. And now a lot of you will probably know that before Sears essentially went defunct, it was in a lot of trouble. And what's interesting is that Sears was one of the anchor tenants at a lot of malls, and typically it would occupy its own spot and often would have a lot of parking around it. And they could basically look at it and see how full the parking lots were. Were they full? Were they not? How did that compare to the parking lots around other areas? And people were getting insights into that. So because of this, I actually am of the mind that there's probably a bit of an opportunity in both cases to, potentially sell some premium near dated and do something akin to our strangle swap types of trades in some of these retail names. Now, of course, we're going to be having earnings coming out ahead of time for many of these, but we are going to be getting earnings after the close. So we'll just take a look here. So after the close, we do have at least one retail name that's going to be reporting. tomorrow, and we can just sort of take a look at whether or not it might make sense to. So Nordstrom's, we're going to have that one, and we can actually take a look here and see what's going on in Nordstrom and see whether this is also somewhat consistent. So kind of a mixed bag here. So the observed customers, not so positive, but the sales slightly better. Transactions per customer slightly better. Sales per customer slightly better. And I guess what the point that I'm ultimately making here is that with that news out, with people tracking that kind of data, perhaps one can sort of fade the implied move. So how might one go about doing that? So we can just pull this in. Incidentally, I had structured two of these for those of you who also are subscribers to the Options Edge, which is theoptionsedge.com. My friend, colleague, the co-author of that, the book of the same name. He writes a lot of articles on there and get a couple trade ideas a week out. We put something up there about this yesterday, last night. So that was actually accessible before the open today, in case you were interested. So how might something like this look? And let's just take a quick peek here. We're going to see where Nordstrom's is going to be reporting the next time, just so we make sure that we capture that. So they're going to be reporting the 26th. So March, if there is a regular way March expiration. It's going to be April, apparently. And let's quickly see what that implied move is, because I usually like to structure these so that they're in and around the implied move, 6%. Oh, less than usual. So maybe someone's trying to beat us to the punch on this one. So we can buy some Aprils, sell some nearer dated. I think I'm just going to use December because I think it's probably fine. $25. So we can go down to, we'll choose the 23 puts. We'll go $2 each way. So that'll be 27. And I've got the 23.5s in there. Let's see, that would be, go up a little like this. There we go. And you end up with something that looks a bit like that. And you can see that actually this near dated premium is a pretty big offset. Let's just make it a straight one. So it's quite a lot of premium actually in that December. It's $1.50 versus going out. So that expires in 25 days. So just over 3 weeks. Whereas the Aprils go out 143 days to capture a couple earnings events, including this one. And those are about 315-ish. So this is, I think this is kind of an interesting way to play it. You might even, let's just take a look at how the near dated, I'm out of curiosity. I just want to see where this one is at the end of the week. 50 cents. That's not bad. I mean, you're getting 1% of the current stock price or thereabouts to sell a $2 out of the money put and a $2 out of the money call each. So that's a decent amount of premium to collect. So you could even just, look to do a weekly and then roll this thing. That's another potential possibility, and I think it's well worth considering. Okay, so with that, I am now going to move on and take a look at some of your questions. And it looks like most of the comments, and I happen to see that out of the corner of my other eye, but I see that a lot of this was related to the echo. Glad that we resolved that. So this is China or U.S. Let me bring that back up. I'm going to bring that back up. So this is China. China's demographics. and this is a couple of years old, as you can see, but the picture hasn't improved. I'm going to throw something else out there that Peter Zeihan happened to say, which I thought was rather interesting, which is that a lot of this data is not being collected reliably in China. There's always been some question about whether the data that comes out of there is a little bit dubious. But he showed a chart that looks a lot like this, and then he showed a subsequent chart where they actually believe that some of the estimates for these numbers might have been overestimates. And it actually worsened this picture considerably. I mean, it took something like 100 million people out on his charts. And I'm guessing because, he's an author. He does a lot of speaking engagements. And I'm sure that some of his material is available online. I encourage you to go look for that and see what he has, because I'm sure there's other sources of it. But, I was just bringing it up because I think it's a good thing to have in your mind as you are looking at where do I want to be positioned. Do I want to be an investor in Europe? And I'm going to put Europe in here next. So that's Europe. And again, China, Europe, and the United States. And you can see that of those areas, the United States looks best. And the United States, for what it's worth, as I was pointing out, we are energy independent. We have we have a disproportionate portion of the arable land. So better demographics, arable land, energy independent. And I don't remember, I think it was Peter who made this point. It may have been somebody else. But, one of the other things is that fertilizer, things like that, so the nitrogen, urea, potash, all of the ingredients that are necessary, and obviously the oil and gas industry is critical because that's a big feedstock for fertilizer. So we've got more of the arable land per capita, and we have everything needed to create the fertilizer, and the climate is, we basically have kind of, on a relative basis, all of the things that we would want. Now, we don't supply all of our own potash, but Canada is one of the largest potash exporters in the world, and that's, of course, on our border and a friendly state. So when you think about it, U.S. always looking a bit fatter compared to the rest of the world, a bit dumpy. Well, in this case, you want to be, right? So I don't want to be, not personally, but demographically, this is what you want. That's the preference. You don't want to have broad shoulders and narrow hips when you're looking at the age cohort of of a society's population. And so I think this is kind of an important thing for us to think about. Was this oh yeah, this is the arable land. I happen to pull this in hectares, which is, but one of the things you can see is that North America, we're here, and we have a lot of it, but we have our population is relatively small. So in a good spot, it should be said, on a relative basis. I'm not going to say we're in a good spot altogether, because of course we also had the unhappy circumstance that we got over $36 trillion in debt and got plenty of problems going on. But I think it's just something for us to think about. Okay. Hi, Mike. Are you taking long positions into 2025 based on economic outlook and new administration, or are you more cautious generally given valuations, rate environment, geopolitical, etc.? So I have a feeling we're not going to get down to 2% in terms of inflation. And this even ignores this whole tariff thing. So obviously, if you have steep import tariffs, it's the exact opposite of the anti-inflationary effects that globalization would impose. It's sort of deglobalization in its intent. which could be a good thing in some context. We need to and want to rebuild our industrial infrastructure. I think there's a cost associated with that, but in general, I think it's something we do need. It is something that we do want. But that comes at a cost, of course. So if we are deglobalizing, if globalization has served as one of the biggest anti-inflationary forces that we have had, and it has, and we reverse that, then we have to also expect that that is net inflationary. So if we do have inflation lingering at levels above the theoretical target of 2%, and I have a feeling that whatever they may not explicitly say we're going to raise that target, but I don't think we're going to hit it. And so that would suggest that rates may not fall as much as people might otherwise hope. So, yeah, I think that the rate situation, I'm a little bit cautious about that. Valuations, I'm also a little bit cautious. And let's look at the S&P for that, so we have some historical context and we can just think about where things are. We're going to look at the forward numbers, and let's just blow this out for as long as we can. Get rid of the price here. All right. So here's where we are. If is price to earnings the right metric to use? I don't know if it is or isn't, but it's worth looking at. This area that I'm highlighting right here, if you can see my cursor, and I'm looking at my screen. Yes, you can see the cursor. So this area is not this is not real. Okay, and why isn't it real? Because price to earnings exploded there because E went down a lot. We shut down the economy, so earnings plummeted. Prices also fell, but not as much, because people expected that someday things would get turned back on. So we can kind of discount this region a little bit. And if we discount that region, so do that in your mind's eye, if you can, and now just take a look back and say, okay, over the last 35 years, this is where if we ignore this, this is where we are. Well, have there been periods when it was higher? Yeah, but it wasn't a great time to start getting long. Right, so this was the tech bubble, of course. Now it got higher than where we are right now. Partially the reason it got higher was because of that E that I was talking about. There were a lot of companies that didn't have real earnings at that time that had grown quite significantly. S&P is a cap-weighted index, so if you have a lot of companies that sort of get into this, into the index and have relatively heavy weights with no earnings, that creates an issue. And so, yeah, valuations are a little bit tricky here. And that does have me a bit nervous. That said, let me see here. I think the value index, not everything has gone up as much. So if we take a look, for example, at IVE, which is the S&P 5, oops, did I do that right? Oh, SVX, sorry. So we take a look at the value index. These multiples are not quite as high. And, so it is above average, but it's not as much. So there are some things that live in here where the valuations are not crazy. And that's probably, so you could do something like an equal weight. You might want to pare back a SPY holding and go to something like a, what is it? I'm trying to remember what the equal weight ETF is. Is it RSP? I think it's RSP if memory serves. So RSP ETF. This is the equal weight one. Obviously, it's done very well. It has looks like a slightly lower volatility as well. You're still buying everything when you buy an equal weight ETF. And what this means is that when NVIDIA pulls another rabbit out of a hat like they did most recently last week, that was quite extraordinary. Actually, that was on Wednesday. And I was speaking to a former NVIDIA exec on Wednesday night. I landed in Miami, got to my hotel, and was speaking to somebody who had worked at the company and consequently owns a lot of the stock. And even people who are the biggest bulls on the company that you can imagine, like the people that work there, of course they're saying to themselves, well, can this growth rate be sustained? Now, it doesn't need to be sustained for that long. When you're growing at more than 30, 40, 50%, you can grow into a very reasonable valuation, assuming that even just sort of grows at the pace of the economy thereafter. So 33.5 times forward in a world where Costco's trading 52, 53, to me, it's just funny. That's, if it's sustainable, it's just incredible. I don't think it is sustainable. 52.5 for Costco, and Costco grows the top line at 11% and is growing. The bottom line. Yeah, so the forecast for the fiscal year ended in August is that they're going to be growing it at 8%, trades 52, 53 times earnings. And NVIDIA is growing at a much faster rate and is trading cheaper. So it seems pretty reasonable. The thing is that I think we all know that, grocery stores, people got to eat, right? And there isn't a big technological transformation that comes around the pike and suddenly means, people are not going to shop at Costco anymore. Everyone's aware that maybe there's a technological development that comes on, and NVIDIA is, not going to be the story. So, let's see here. All right, Anil, with Trump's crackdown on immigration and recent increased productivity, do you think supply constraints to stay higher inflation above the Fed target and may cause a recession next year? So the border czar, Homan, that was appointed, he has explicitly stated that his first objective in terms of cracking down on immigration is to go after those who have been convicted of crimes and so on. So they're really trying to get the criminals out of here first. Those who are involved with drug trafficking, those who are involved with gang activity, have committed crimes. That's their objective, is to get rid of them first. And there's a lot of them. So that's not going to be harmful to our productivity, as far as I'm concerned. Now, what I would like to see, I don't know that we will see this, but what I would like to see is a couple of things on the immigration front. First of all, H-1Bs, we need more of them. So I would be very much in favor of encouraging and expanding and accelerating the legal, the legal paths to work here. So one of the things we keep hearing is it's going to affect agriculture. Well, we have a guest worker program in agriculture. That's the good news. The bad news is it takes 60 to 75 days, and there's an unlimited number of them, right? So you can get a guest worker. It's a 3-year permit. You have to go back to your home country, I believe, for 3 months. Within that 3-year period, the problem that I have is that it's a 60 to 75 day approval process, and they put too much hair on these things. That does nobody any good to make these things difficult. So they need to accelerate that process and document more of the guest workers. So that would certainly be an objective. It could also be expanded to other areas. Home building would be a very obvious example. There are a lot of immigrants that are working in home building, and to the extent that we need those people here, then we could come up with a guest worker program similar to what we have in agriculture, which also needs its own little overhaul, but you get my point. So, those things could solve the productivity problem very, very quickly. And, if people are being practical about it, that's the approach they should take. But I think the good news is, just to put a pin in this one for now, because we have to wait and see. We know what they've said, but they're not in Washington yet. But Homan has said he's going to focus on the criminals first. And if that's true, I don't expect any big productivity declines. I think that's probably going to be okay for now. Okay. Yeah, Tucker D. Dog says home builders are not really under H-1B. Yeah, I know that. So what I'm saying is we need something like the H-2As, which is what you have for agriculture. H-2As, I believe. You can double check on that one because I'm going off of memory. But the H-1B is for skilled workers. And I'm familiar with the H-1Bs because I used to employ people who are on H-1Bs, if they didn't have green cards but had very specialized expertise. In fact, you will know when you see a job posting whether it's an H-1B job, because very oftentimes the job description is very specific. I need somebody who speaks these language codes in these languages, who's 5'7" and weighs 145 pounds or whatever it is. It's the H-1B, because by law you have to actually post that you're looking for that person, but very often you've already found the person that you need. You've already found the person that has the skills that you want, but you have to go out and look for them internally first. So you'll see those ads and you think, wow, that's really specific. That's oftentimes because they already have somebody. So yeah, it's the A's that are agriculture. Create an H1H, for home builders or something like that. It seems to me that this would be helpful. Okay. Peter Zahan sometimes exaggerates his points for clicks, in my opinion. Look, I'm probably, I'm a rather dry person to listen to. I'm aware of that. I don't make punchy. I don't have a really punchy delivery, and I tend to sort of think out loud. And he is the opposite, right? Some people, they sell it a little bit, and he is one of those people. And I don't necessarily agree with everything he said. I'll give you an example. So, his view as he looks out at technological development in the area of AI and robotics. We had a lot of people from the world of AI, a lot of people from the area of robotics, both from academia and industry from around the world, who came to this conference and spoke. And, Peter Zahan's view was that there is a pace of artificial intelligence and robotics growth and the capacity, both, 5, 10, maybe 20 years is his sort of pace of play in certain areas of technical development. And in terms of bandwidth, he thinks that of the big problems that we have, it's not capable of resolving all of them, and we're going to have to. And I think if I interpreted him correctly, that he was approaching this from the perspective that some top-down view of how we were going to deploy our resources was necessary. I disagree with the pace that he anticipated, partially because I've worked with an artificial intelligence team, and there's a lot of things going on that people don't see in the area of AI. The team that I was working with focused on combinatorial optimization as well as machine and deep learning. And everybody is looking at, language models and chat GPT, and this is their perception. So they think about general AI, they think about large language models, and there's a lot more going on, and it's already improving productivity. The CEO of TradeStation himself was just talking about the evolution and how quickly it is impacting sort of the middle office of their business. And, the impacts appear to be profound. And we've got machines coding now. I guess I'm more optimistic, I would say, on the potential productivity gains that we can get from this than Peter was. And so, I'm hoping we actually grow into the valuations that we have. That said, I am a little bit cautious. I think I saw somebody say, oh yeah, so put spreads on FXI. The only problem that I have with this is that the valuations are already so weak. PC, could you look at Dick's Sporting Good and Best Buy? So Dick's is a remarkable story. Here, let me pull that up on my screen. This thing was outperforming for a while, and then obviously not as much now. But I mean, this thing last year was just going absolutely gangbusters, quite extraordinary. So why don't we just take a quick peek? Weren't specific about what you wanted to look at. Was it the alt data that you were interested in? We can pull that up. So, and look, this is anecdotal the way we're doing this. We just showed, I'm going to pull the chart up on a different screen. But if you take a look at the price action in these stocks, so you can see this one's been kind of moribund lately. And then you take a look at the alt data, and you can see that observed sales over the last 7/28 3-month period have been a little bit flatter. It ties, right? Correlation is not causation, but this is data that institutional investors have access to, and it could be influencing their decisions, and it fits, right? So let's take a look at that. How's the street feeling about this? Looks like we've seen some downgrades. That's what this little down pointing red triangle means. That, the street's getting a little less optimistic than they were. Valuation could be one of the reasons. We can take a look at that. That's actually not that bad. I mean, it's above its average. So if you look over here in this table, this is the historical average over the last 2 years, and this is where the company resides now. So on every one of these metrics, you can see that it is trading at a premium to its own history. And if we can actually expand that history if we like. No, we can't, because I guess it doesn't have history going back that far. Thought we could. Depends on the name, but in some cases we don't always have that. But yeah, it's trading a little bit rich compared to its own history. How big a move is this one implying? 9.5%. I mean, I would, one of the things I will say is that, did I show? I may not have shown that. You can look at this. New York Fed puts out sort of this state of the consumer, and basically what we're seeing is that consumer delinquencies, auto loans, credit cards, you name it, these things are all getting up to decade plus highs. And it's going to have an impact on retailers outside of those that are focusing on the most affluent. The most affluent in this society have gotten a lot richer of late because stocks are going up, right? All of their assets are going up. So things look great to them. I have a feeling this actually tells a little bit of the story of how the election turned out, that there is a cohort that are doing exceptionally well. Everything they look at is turning green, so they think everything's dandy. And then you have the middle to lower end consumers, and the evidence suggests that they're not enjoying things one little bit. And that can weigh on sales at outfits like Dick's. We will see. But I think the demographics of the retailers you look at is going to be a really important thing to think about. Anyway, thanks for your input on Peter Zeihan, for those of you who follow him. I didn't really, right? So he and I, we were speaking back to back. He was first, and I was on a panel that came second. And so we were on the first shuttle from the hotel where we were staying to the event, which was being held at the Donna Shalala Center at the University of Miami. And I'm not going to try to embarrass the guy, but I'll put it to you this way: we were on this thing, and the driver of the shuttle got lost, and he was about to drop us off at some random place that wasn't even on the campus. And Peter was supposed to be the first one to speak, so that's when I actually met him, because we were the only two on that bus. But yeah, I had not listened to him before. But I love data. You can take it, and maybe some people sex it up a little bit, tells a story. If you're a gloom, doom, and boom kind of person, then blowing the data out of proportion is going to be a part of it. I'm not saying that's what he does, but he makes it a bit salacious. Okay. Let's see what we've got here. Spicy barbecue. With the record number of bachelor degree holders being unemployed, H-1B bad. Well, I mean, that depends on what your bachelor's degree is in, right? So if you need somebody with a background in engineering, 100 people with sociology degrees isn't going to solve your problem, right? So to me, it's knowledge more than, a bachelor's degree. Any one of you watching can educate yourself and become very conversant, fluent even, in almost any subject that is of interest to you, including doing things that are, generally spaces that are occupied by, pretty brainy and well-educated people, like volatility trading. It's a little quantity and takes some modeling, but the information is there. Everybody who's sitting here watching me right now, do some homework, dust off some of your math skills, and your Excel skills, get some data, and you could do it. Do you want to? Oh, I don't know. I mean, you're going to be competing against some pretty savvy folks, but the degree that you hold, I'm not sure that's the most important thing. Actually, I'll mention this. So at the conference, speaking, while this was all going on, a guy held his hand up and he said, he was talking about the demographic situation in the United States, and he pointed out he was a mechanic. He said his first job, when he became a mechanic, he was getting paid $10 an hour, and his first house cost $44,000. And the point he was making is that his own kids, going to college, they could not achieve what he was able to achieve with a blue-collar job. And there's a lot of evidence of this, that the cost of housing and some of these other things has gotten much higher relative to median incomes, even amongst the educated. And what is educated? It's not, once upon a time, I think people went to college so that they could demonstrate that they had learned how to think. I think now people are much more interested in seeing if, when you get out of college, you learned how to do things that are of value. And somewhat more dubiously, I think that it's fair to say that some people are wondering whether kids coming out of college are learning how to think, or at least think for themselves, because there seems to be a bit of groupthink coming out of there too. And not every employer is enthusiastic about the ideas that they're coalescing around, which is its own kind of a problem. Best Buy trades like, choose the four-letter of your preference. Let's take a look at Best Buy. Ugh, right you are. Well, it filled this gap, and it's up today, so that's good news. I still go to Best Buy from time to time, I have to say. It's one of the few stores I go to, because sometimes I need something, and they're the kind of place that would have it. Once upon a time, people... Do they make money? I don't know. Radio Shack... There used to be Radio Shacks everywhere, and every now and again, you would need something that a Radio Shack had, and you would go there, and they would sell you some little electronic gizmo-y piece for $3. There was no way they were going to make money doing that. But if they can hold in here at these kinds of numbers... That's not terrible. It's not priced for growth. So what I'd really like to see is their digital business That's kind of critical. Yep. So let's see here. And there was a question. Here we are. So Tucker D. Dog, I've never hired an offshore developer based on their degrees. Only experience. They may well have no degree for all I know. Right. I mean, it's about skills. That's the most important thing. So where is this IV question? Is there? Okay, here we are. Is there a way to compare implied volatility for near-term event risk versus farther out expirations, like crowd this week? Yeah, look at the term structure. And chances are, I don't know what brokerage platform you use, but there's a good chance that you're going to get something that looks like this. So you can see that the near-term implied volatility is quite high, 100, versus being in the 40s. Now this makes sense when you consider all the news and problems that CrowdStrike had. I think that what Delta was trying to get $500 million out of them. I think that probably represents the worst of it on their side. Let me go back to this chart for a second before making a point, and that is that when you look at a chart like this, and you can see that near dated implied volatility is much higher than the longer dated. Remember that as an event approaches and as the amount of time to expiration gets compressed. So this front month expiration, these are options that expire on Friday. Okay. So we've only got 4 trading days. We don't have 4 trading days because, of course, Thursday we're off, and then you have some sort of half-ish days in there, Black Friday and so on. So you can think of this as really an option with, 2.5 days to expiration in it, trading days. It's kind of the way to think about this. And so the implied volatility is actually going to shoot up, even though the premium is not necessarily getting any higher. And that's because it's all event variance. The straddle is completely priced on the event. So is it appropriately priced? Well, first of all, in their case, a lot of people are going to be trying to figure out, did corporate clients decide after what happened that even though they are kind of the best in that space, in that security space, that maybe they want to consider other vendors? And so that uncertainty, which some people might think is going to be resolved with this earnings release, is going to contribute to the implied move. So in this case, the implied move is about 8%. All of that associated, and let's double check that because that's what Bloomberg is saying the number is, but we actually want to double check. So stocks trading 363.5. We'll use the 362.5. Call it 16 and 14.5. Oops. Uh, 363 spot 7, we'll call it. So 8.4%. Yeah, so Bloomberg actually did the math right. Looks like about an 8% move. So that's all of what you see in that front month straddle is associated with that. Now, let's take a look at where the stock has been trading and decide for ourselves, is $30 higher or lower reasonable? Now, this is interesting because, the stock has obviously rebounded very, very sharply off of that bad news and is, back to levels, very close to the all-time highs, really. So $30 from here. So this is where we are right now, right there. Okay, so it closed basically on the lows here. So, $30 gets you up to almost the all-time highs of 398. And that's going to take you down to 330-ish. This is right around the 200 day. So if you were thinking about doing something like a strangle swap, and I haven't really, so we're kind of working through this exercise together, but bear in mind I hadn't really looked at it, and probably was just because I don't have that much of an insight into how corporate clients are viewing all of this and whether we're going to start seeing an impact here. A lot of people were asking, in fact, actually at the conference I was asked about CrowdStrike, and I kind of waffled on it a little bit because I don't have a really strong view. Especially considering its valuation relative to some of their lesser competition, and just wondering whether the lesser competition might be viewed as not so much lesser after that debacle. But let's just take a look at what the break-evens would be, at least as far as this thing sees it. So I'm just going to go back to, we'll just pick the weekly, why not? So we'll go up and down by, call it $30. So we'll use the 330 puts. And to see what the break-evens kind of look like on this thing, we'll go up to 400, why not, on the call side. And then add a call and a put here on for a longer dated expiration. Let's go out to, I'm going to use March. I should probably double check, see when their next earnings is. It's almost certainly going to be in April, I would imagine. Oh no, it's actually early. Oh, there we go. So look at that. That's March 5th. So March will capture it. All right. So that's fine. So we'll go to the 400s here and see what this thing looks like. And the 330s on the put side. That's pretty pricey still. So $58 over 364 round numbers. Yeah, I mean that calendar, that strangle swap is going to cost you 16% of the underlying stock price. That seems pretty chunky. Consider that one of the other ones I was looking at, which went out to April, I was looking at one in Halliburton. The idea being that, some folks are trying to figure out, are oil services going to get a boost because of the incoming administration being favorable to oil? As I've already pointed out, it's kind of driven by oil prices. We're already at peak production in this country. That was a $2.50. You're paying $2.50 to buy the Halliburton April 32 calls, and then selling a nearer dated, 3034 strangle at like 55 cents. So you're paying $2 over 32. And, that's 6%. This is 16%. Now, granted, it's a much more volatile stock, but that's a lot of premium to outlay. So I'm not as crazy about it here as I am in something like a Halliburton, where you can just sell more premium against it. As soon as the short dated stuff rolls off, you can do it again. I think we're not really going to see how that plays out for some time, so that sets up nicely. So even though you can see this term structure here is quite steep, at least optically, you have to think about how much you're actually paying for that longer dated stuff. And in this case, it's a lot. That's a lot of premium. And if vol gets sucked out of that, that Vega could bang you up pretty good. What platform, Alex V, what platform are you trading on? I use Interactive. It's not a recommendation. But the reason, force of habit, I guess. I opened up an Interactive account more than 20 years ago. And, one of the things about it, obviously I'm assuming you're not talking about this is Bloomberg. I use other systems. Obviously I use Options Play, as you guys have seen. I've been taking a look at some stuff from Easy Trade, which is going to give me some statistics on probabilities. And I'll be highlighting that in future videos, which, by the way, is going to come up with statistically good trades. So every single time, it's, I'm not going to be coming up with my own ideas. I'm not necessarily going to be looking at catalysts. It just, high probability trades percolate to the top in that application I'm playing with a little bit before I start sharing it with all of you. But I don't know that it makes a difference because a lot of these platforms have gotten, my understanding is quite good. They've got secondary, tertiary Greeks in these things. Not that you need them so often, but a lot of functionality is being added. So whether you use Thinkorswim, now part of Schwab, I haven't seen Fidelity's platform of late, but I'm sure it's fine. E-Trade, TradeStation, whatever. I'm sure these things are all good. So, just force a habit. That combined with the fact that, Interactive Brokers was built on a market-making platform first. Tom Petterfer used to run a market-making operation that we competed against called Timberhill. Timberhill is no longer, I don't think they actually trade prop anymore. But, it was built by vol traders. So because of that, naturally I gravitated towards it because that was my background. And I saw them using their platform. I knew they had direct exchange connections. They weren't leveraging other people's pipes. They might now, for all I know. But force a habit. I don't know that it really matters though. If you like the platform you're on, stick with it. With one important exception. I'm not going to name names on the platform, but suffice it to say, I knew an executive at the company, and I was talking to them about something, and one of the things I learned was that their rates that they were charging were very, very different. Interactive Brokers' interest rates are not that far off what institutional traders might expect to pay. So the spread between your long and your short rates and things like that, it was pretty close to having what we used, what was called a JBO, which stood for a joint back office. So, prop trading firms typically would clear their business on the balance sheet of a larger firm. So it could have been Spear Leeds, which got acquired by Goldman Sachs. So you would clear Goldman, or you would clear Merrill, Bear Stearns back in the day. Obviously, that's part of JP Morgan now. And, we would pay spreads that were, 20, 30, 40 basis points, long, short, sometimes a little bit more. Obviously, that depends if his stock is hard to borrow. And I saw a retail platform, and they didn't have this concept of these rate spreads. So, when rates were high, the difference, you weren't collecting on the short side, and you could be paying away 4.5%, 5%, 6% on your borrowed money. Now, if that's what your broker is charging you, and you need to go and check and see that yourself, then you should change. If you use leverage and you're paying too much for it, that's a killer, right? You shouldn't be doing that. That's like going and buying your car and using your credit card to do it instead of, getting the 2.9% that they're advertising for 60 months. They're like, I'll pay 29%, and get the points, my air miles or whatever it is. You don't do that. So that's the only caveat I would say. Check your financing, your funding rates, and compare that across platforms. The commissions on all of these things are very low or non-existent these days. In my case, I actually pay the commissions. So Interactive has a commission-free option, I think. But, the commissions that they charge are reasonable, and I like to have more control over the way I fire the orders in. So generally speaking, on commission-free platforms, the way they make their money, other than the float, which is you having your money on their platform, is what's called PFOF, payment for order flow. So they take your order, and if it's a market order, which I don't recommend, use limit orders, use marketable limit orders. A marketable limit order is a limit order with a price that's likely to get filled. So please do that. I guess while we're doing the PSAs right now. But if they send market orders or marketable limit orders to destinations with whom they have special relationships, they receive payment for order flow. And for a lot of these brokerage platforms, that's the lion's share of how they make their money. And that can be fine for most retail customers, but just bear in mind that their routing rules are based on what compensates them best, not what gets you the best fill. Bearing in mind that they can't violate the top of the book, and they probably are going to still comply with price improvement mechanisms. The exchanges have PIPs and PIMs, which are price improvement mechanisms, where they fire an order and give you like a penny price improvement, that kind of thing. So those are the only things I would watch out for. Most people don't need to think about that much more than that, though. And then aside from that, it's really look, feel. Do I like the way this displays data and relays it to me, that kind of thing? And do I like the feature set? That's pretty much it. I'm not too particular, and arguably I'm also not too particular because I haven't used all of these things. And in fact, very often on the institutional side, we had our own trading side, and then we just connected to them on the pipe side on the back. So we could even fire orders in from an Excel sheet, for example, or out of the Bloomberg terminal. So there's something called EMSX, which is not going to be enabled on this one because I don't have this particular terminal plugged in. But for years I would use EMSX plugged into the backside so that I would be able to trade remotely if I had to. And with that, I have chewed up an hour and 15 minutes of your time, given the fact that I think we got off to a 3-minute delayed start because we were having a technical snafu. So for those of you who hung around and heard me ramble on about subjects far afield of one another, I really appreciate it. And I hope you like, subscribe, and tell your friends. And like I said, we're going to start bringing this easy trade functionality in and just showing some high probability trades, which may interest you. They may not. We'll see what happens. But I'm going to play with it for a couple more days before I start showing that, just to see what I think of it. But I've known the guy that developed it, and it's used by a big team in Morgan Stanley. They really seem to like it. They've been using it for more than a decade. And you guys might like it too. So if you want to see that, be sure to tune in for the next one, which will be on Wednesday at 4:15 Eastern. Thank you for watching.